Hi, I'm Justin Miller with the Chong Miller Group, and welcome to Ask the Professor, and specifically the three-part mini-series on inflation, interest rates, and the housing market. This is part 3, where we look at what we've learned in parts 1 and 2, inflation and interest rates, and apply that directly into the housing market to get a better understanding of what impacts housing prices, what impacts housing sales, and what we might be able to expect going forward in time, both from an underlying theoretical perspective as well as from a practical perspective based on what's going on in the economy right now. So please subscribe, smash the like button, sit back and get ready to learn about the housing market as seen through the lens of inflation and interest rates. We've just recovered effectively all of the jobs that were lost during the pandemic shutdown. Here we are 2 years on from that. And the Fed is talking about maybe we need to reduce employment levels. Problematic. Well, what's it mean for housing? This is why I say interest, inflation, housing, they're interrelated. So let's turn our attention now. So, housing prices. As you know, if you've been watching the market update videos that I produce every month, single-family resale residential in Las Vegas, prices have been on a tear. They've just been going up and up and up, and that's been true for a few years, right? In fact, rather interesting year to date, prices have increased from $394,000 at the median at the end of December or beginning of January of 2022 to $475,000 at the end of April, beginning of May. That's a 20.6% price increase at the median for Las Vegas single-family residential resale so far this year. And year over year, so looking back to the end of April of 2021 relative to the end of April of 2022, we're up 28.0% for single-family resales. Now, we're up 40.7% at the median for condos over that 1 year period of time, and we're up 33.7% for townhomes over that 1 year period of time. Prices have been really strong. But it's not just 2022. If we look at what was happening in 2021, prices were escalating strongly. In fact, at the end of 2020, in about October of 2020, I had predicted that housing prices would increase in 2021 by between 12 and 15%. And as we were getting toward the September timeframe in 2021, I was saying housing price escalation, appreciation was going to cool off and be approximately zero for the remainder of the year, so that we would end up only about 18%. Housing prices did not stop going up late in 2021. So we ended up actually almost 24%. Year over year for the entirety of year 2021. Well, they didn't actually start going up in 2021. They were going up in 2020. And they didn't even start going up in 2020 by September of 2019. We were pre-pandemic. The coronavirus had not yet been identified as COVID-19 because it had not yet even been discovered in China. The interest rate policy of the Fed was one of marginal tightening. And we already started to experience price increases here in the Las Vegas Valley. In fact, it was kind of interesting. The US Fed had started a tightening cycle for interest rates in beginning of 2017. Prior to 2017, going back to the financial crisis. The target rate was 0.25 to 0.5%, so 25 to 50 basis points above zero. And as we were sitting in the early fall, late summer of 2019, the federal funds target rate had already increased to a range of 2.0 to 2.25. So that's an increase of 175 basis points, 1.75%, over that intervening 2-year period of time. As we approached September of 2019, we started seeing price escalations becoming more consistent, even at these higher interest rates from Fed policy. So this is kind of interesting. Right now, we're in an environment where the Fed is tightening again. We've gone from a range of 0 to 0.25% on Fed funds up to now 0.75 to 1.0 on Fed funds. So we're at half the level that we were at in the summer and fall of 2019. And they'll continue to go up. But that was a significant increase that we'd experienced. So over a 2-year period of time, 175 basis point increase in that particular period of time in 2016 to 2019. So with increasing interest rates, we saw housing prices start to go up. And I'm pointing this out not specifically because of that interest rate issue that was taking place at the time, but rather I'm pointing it out because it means the price increases that we've been experiencing predate the pandemic, predate the dropping of the Fed funds rate down to that 0 to 0.25% range that was a response to the pandemic and the lock-ins that were mandated by government policy. So to maintain a suggestion that the only reason we had prices going up was because of very low interest rates, or it was because people really wanted to change their living environments because they had been locked down during the pandemic, ignores some interesting historical fact that we had been just before the pandemic in an increasing interest rate environment, and prices had been going up and sales had been strong during the year of 2019. So we're in very large measure continuing with the trends that had been put in place prior to the pandemic and to the lockdown and to the ultra low interest rates that were the result of some level of Fed policy. So why are housing prices going up? Housing prices are going up because of demand issues and because of supply issues. Now remember, the cost of houses, not housing, but the cost of houses is not part of inflation. It's the cost of an asset class. And we're up strongly. We're up very strongly. We're up 20.6% year to date, so the first 4 months of this year, and we're up 28% year over year, looking just at single family residential resale in the Las Vegas Valley. Prices go up because of supply and demand. In reality, supply is very constrained. Inventory in April of 2022 just came off a record low. So we know that interest rates are used by the Federal Reserve to influence the level of activity in the economy. The Federal Reserve uses its blunt instruments of the federal funds rate to signal to the bond market what they want interest rates to do, to go up or to go down. But it's only the federal funds rate, the overnight rate, that the Fed actually controls. We also know that since 2008, the US Fed has employed a policy regime called quantitative easing and quantitative tightening, wherein the Fed goes into the actual bond markets to buy up supply or to unload some of their supply of bonds that they've accumulated, thereby directly influencing the rates on other types of long-dated securities. When the Fed works in the mortgage-backed securities market through quantitative easing or quantitative tightening, they have the ability to more directly influence the mortgage rate regime. The challenge, though, is it's still the market of bond buyers and bond sellers who are going to determine what actual interest rates are. And right now, interest rates have been going up in the mortgage-backed securities market. They've been going up more quickly than the Federal Reserve has been implying interest rate movements in the federal funds rate. And they've been going up more quickly because there's some level of speculation right now in the mortgage-backed securities market where bond buyers have decided to leave the market, reduce some level of activity. That's caused the bond prices to go down, which means that bond, in this instance, mortgage interest rates go higher. At some point in time, in the not terribly distant future, it could be a day, it could be 5 weeks, bond investors are going to step in realizing the mortgage interest rates calculated through the mortgage-backed securities market have become simply too high. They're not warranted in regard to the way the Federal Reserve is actually implementing monetary policy through interest rates and quantitative easing. And when that happens, bond investors will come back into the mortgage-backed securities market, increasing demand for mortgage-backed securities, causing increased prices for mortgage-backed securities, which will cause interest rates to come down. In fact, as I record this in the third week of May, the national average for mortgage interest rates has actually come back down from 5.36% to 5.25%. So mortgage rates will move up and down. They'll continue to, because the bond market itself is dynamic. I expect that mortgage interest rates will fluctuate this year between probably 4.75% and 5.4, 5.5 maybe percent. Now, why is the Federal Reserve interested in interest rates? The Federal Reserve uses interest rates to influence the rate of inflation in the economy. As interest rates go higher, the cost of money goes higher. That pulls activity in the marketplace, generally speaking, lower because it costs more to engage in any activity. And so the Federal Reserve increases interest rates when it's trying to restrict or lessen the rate of inflation. Conversely, they try to lower interest rates when they're deciding that they need to increase the level of economic activity because inflation is too low or because unemployment is too high. Now, what's going on with inflation right now? Inflation is certainly elevated. And remember, inflation is generalized increase in the cost of consumption. And so when inflation is higher, the cost of consumption is higher and going up at a more rapid rate, which reduces the level of consumption activity that people can engage in. And therefore, inflation is itself partially self-correcting because it's more expensive to buy things, people buy less, which reduces aggregate demand, which therefore brings prices down. Interest rates work in the same way, reducing money demand, the ability to go out and borrow money, and the desire to do so means that people have less money to spend, and therefore they reduce their level of aggregate demand. When inflation is high, that means the cost of living goes higher and goes higher at a more rapid rate. That means people have less money in their pockets or their pocketbooks to be able to spend on other things, including making investments into asset categories, such as housing, where housing itself is an asset category. So if we were to see housing prices appreciate, Does that mean there's inflation? No, because housing is not a consumption good. So how rental of housing is. So housing prices calculate into the inflation gauge only through rental rates and owner's equivalent of rent, not the actual prices on the underlying product, which is housing. So much like gold or dollars, these are asset categories that may appreciate, they may depreciate, but they're not inflating and deflating. They're not in that same category. But so as our asset price housing increases, appreciates, that means housing more expensive. The actual investment of housing becomes more expensive. As the Fed reduces the level of activity in the economy by increasing interest rates, that makes it more expensive to borrow money, such money that you might put into buying houses. And so in the aggregate, both higher levels of prices for houses and increasing interest rates makes it more expensive for people to buy houses, which may reduce the level of demand for housing. But if inflation is caused by a supply issue instead of a demand issue, or if asset price appreciation is caused by a supply issue as opposed to a demand issue, then while the increasing prices because of a lack of supply might reduce demand still further, increasing interest rates do not solve the problem because they make it more expensive to engage in the investment activity that would produce more product or more asset class items. And so raising interest rates in an environment which is actually exhibiting supply constrained price appreciation on assets and inflation in the overall economy is contraindicated. It's not the right policy. That does not mean the Federal Reserve is not going to make a mistake. They're clearly increasing interest rates at this time. And the chairman, who was just sworn in today as I record part of this video, has been announcing recently that the Federal Reserve may increase interest rates sufficiently to actually tip the economy into recession. So as it relates specifically to affordability for housing, if we increase the price of the capital asset, the house, that makes it more expensive, and some people will not qualify to be able to buy the more expensive house. If we increase mortgage interest rates, that makes it more expensive to carry the loan on the house, and some people may not be able to qualify for the more expensive payments on that house. And combined, more expensive house and more expensive payments on that house could restrict some level of demand by pulling people actually out of the market because they no longer qualify to be in the market. Offsetting that, though, there are other people who may step into the market. The Las Vegas economy is not a fixed set of people and activities. Rather, it's a growing economy. People move here for jobs. Increasingly, they move here for school. They move here to retire. All of those new people need housing. And some of them come with significant assets or significant income levels with which they may qualify to buy housing. And they might want to buy housing more quickly than they might otherwise because they're concerned about locking in relatively lower interest rates than they might otherwise. So for those who are out there saying that higher prices and higher interest rates will remove people from the housing market, and those who had pent-up demand jumping in will be eaten up in terms of their volume quickly, and there won't be anyone else to step in, they're missing the dynamic that actually defines the economy, which is growth. And that's a really important thing to miss in one's predictive capacity. So let's look at what happens with housing price affordability. If we take the peak in June of 2006, For single-family resale residential in Las Vegas, $314,700. We cannot compare that directly to housing prices today because those were $2006, and we live in an economy denoted by $2022 because of inflation. Inflation makes it more expensive to engage in the same level of consumptive behavior. Appreciation makes it more expensive to engage in the same level of investment behavior. And so we have to deflate those dollars from a different period of time in order to actually talk about constant year dollars, so that we look at the same kind of purchasing price parity across time. So when we take the 2006 median home price of $314,000 and we apply the inflation adjustment to it, that gets us to $448,000 in 2022. So we've just hit that number earlier this year in the month of February or the month of March of this year, that we got back to the prices that were paid at the very peak in 2006. Now, most people don't buy at the very peak or sell at the very trough, nor do most people buy at the trough and sell at the peak. So we don't want to try to draw trend lines through those data points, but we can say that top price was equal to just a little bit less than what the median price is now. But interest rates were different then, right? We're in an increasingly tightening interest rate environment right now because the Fed's moving to tighten interest rates. But actually, interest rates were higher in 2006. In 2006, the average interest rate for a single-family mortgage was, for a 30-year fixed rate mortgage on a single-family home, was 6.75%. Today, that mortgage rate is, let's just say it's 5.36%, even though it's actually come down in this past week. But what that means is, even at the $475,000 median price at the end of April, with that 5.36% interest rate, that gives us a monthly cost of carry on a 90% loan-to-value mortgage that's $221 less than what people were paying in 2006. So it's actually less costly to own your home today, median home, in Las Vegas than it was in 2006. We think in Las Vegas that we're our own little economy, which in some manner we are, and we think that we're special, which in some manner we absolutely are. But we also tend to forget that there are other local economies, and those local economies may be experiencing similar issues to what we are. And in fact, prices have been very strong across the country, and Las Vegas is actually not a standout in regard to the appreciation of housing prices over this past few year period of time. And so there's an interesting article. Now, I'm not able to duplicate this author's methodology because it's not disclosed. But what this author actually reports is the 15 local markets where housing carry costs increased the most from 2020 to present. The local area, the city, that had the greatest increase over that 2-year period of time in carry costs, how much your monthly payment would be on the mortgage for the median house at the median interest rate, was Austin, Texas. In Austin, Texas, the median increase was 93.5%. That's pretty impressive. A damn near doubling of the cost of owning a home over a 2-year period of time. But Austin isn't the only one. Boise, Idaho, 84.7%. And then 5 different cities in Florida. And then we get to Ogden, Utah. Increase 80.8%, so 81% approximately, in Ogden, Utah over the course of 2 years. Also Provo and Salt Lake City. Las Vegas isn't on the list in regard to their cost of increase over a 2-year period of time. So what are the numbers for Las Vegas? Trying to duplicate the methodology that was used by that author in this report that was published by the National Association of Realtors on their website. Las Vegas, over a 2-year period of time, because of increasing median sale price as well as increasing interest rates, the median cost of carry on a home over that 2-year period of time was a 36% annual increase. Las Vegas is not one of those areas that's growing most rapidly. That's a rather interesting thing. So it's definitely costing more to buy a house and to carry that house. And it's costing more at a lower rate of increase in Las Vegas than in some really hot markets around the country. So housing today, no more expensive at the median, in fact, less expensive at the median than it was in 2006. Now, as we get through the remainder of 2022, housing prices will continue to go higher. I do not believe interest rates will be going very much higher, but we'll close that gap and we'll get back to the kinds of prices that people were paying in 2006 on a monthly carry basis. We'll go higher because there is asset price appreciation in housing, and we're not sitting at the very bottom of the interest rate cycle. But affordability is less of a concern today in actual reality than it was in 2006, prior to any collapse of the housing market or any collapse of the financial sector of the U.S. economy. So I provide this information because I want you to have the relevant knowledge about what it is that actually influences the economy and houses. I don't want you to be subjected to and make decisions based only on all of those other people out there who are providing you with limited insight to talk about some particular point that they want to make. For those of you who've been watching some other people out there, or listening to some other people out there, or reading some of the other people out there who've been telling you housing prices are going down, you've been listening to the wrong people. And they've been telling you things that constitute bad advice. Housing prices have not gone down. The housing market has not crashed, and it's not going to be. We have long-term demand issues in place, and we have long-term supply problems in place. And as the Federal Reserve increases interest rates, on the one hand, that may draw down some level of demand, but it's actually going to exacerbate the supply problem. There's no escaping where we are right now because we're in a generational shift to a higher appreciation level in the asset class categories, especially for those important asset class categories that people actually engage in on a daily basis, such as housing. I produce monthly market update videos for single-family residential resale in the Las Vegas Valley and for condo and townhome resales in the Las Vegas Valley. And I supplement those videos with these Ask the Professor videos, wherein I explain through sociological theory or economic theory what's actually going on in the economy, why it's going on, and what the implications of that are for the housing market. Well, that concludes our 3-part mini-series on inflation, interest rates, and the housing market. I hope you found this mini-series to be insightful and that you've gotten to learn a lot about why I, as a professional real estate agent in the Las Vegas Valley, think that the housing market will continue to show significant appreciation and significant transaction volume over the next remainder of this year, but actually over the next several years. Inflation, interest rates, the housing market, they're all interrelated. They're complex interrelations that combine, along with demographic trends, help to really cause one to understand and be able to project forward what may actually be happening with regard to housing. Your house that you want to buy, your house that you might want to sell. Please, if you have comments, leave them below, subscribe, smash the like button, and if you want to talk, please reach out, give us a call. I'd love to talk with you and see how we might be able to help you with your real estate activities. At the Chong Miller Group, we help people buy and sell houses. Thank you very much.